Yeah, I think it's a great observation. I think it's important for people to have the context of not just, all right, the market's rallying, but like we're in earnings season, and we already knew going in the standout earnings growth performers were mostly, not all, mostly going to be concentrated in and around the AI CapEx theme. It's the whole economy right now. So look, there are times where we have an economy that's driven by this phenomenon, that phenomenon. Sometimes it's a big tax cut. Sometimes it's, some sort of an industrial boom. Sometimes it's the housing market. It's the AI CapEx story. That's what's going on. That's what the leaderboard of the S&P 500 for the most part reflects. Doesn't mean that we don't have stocks going up in healthcare, because we do. Doesn't mean we don't have stocks going up in consumer discretionary, because we do. But the vast majority of the gain that we're getting on profitability, it's coming either directly, like these freak show memory chip stocks, which nobody should think they'll ever see anything like this ever again happen overnight. But even putting that aside, when you listen to the commentary coming out of the Caterpillars of the world, we have this moment where people are building very large-scale projects, and that's engaging some of the most important companies away from tech as part of that. And I'll throw utilities in there. So that's what's driving the earnings growth. That's what's driving the economy. That's what's driving investor enthusiasm. So that separation that you described, Judge, nobody should be surprised by it if we think that earnings are the most important ingredient into what makes stock prices move.
Making some people certainly nervous. Julian Emmanuel, who's bullish. The market was with me yesterday on Closing Bell of Evercore and raised his earnings estimates, but said there's a lot of similarities in some of the things that he's seeing in this market between today and 99. I mean, Josh talks about what's happening with Micron and some of the memory names. Show Micron again today. I mean, it's like every single day. 12% today.
Not normal.
Intel, Intel had the feel as though it was, if not, back it up a lot longer. So it's up 14 here, but I don't know, a few years. Intel had this feeling within the marketplace among the investing community as like this thing was on the outs with its nose pressed against the glass and it was never getting into the party. Government takes a stake, and all of a sudden that and this is now a major data center play. And I don't know how you would characterize that move from 40 to over $100 a share. But are these things that need to be time stamped? Because I've got people who are messaging me saying this is now the theater of the absurd, and it's not going to end well.
I think that you could clearly identify areas of the market where that's an accurate statement. And I think the market has excessive speculation for sure. Do I think there's universal excessive speculation? Not to the degree that we saw it in the late 90s. And I think the pre-existing condition that kind of benefits the environment now and allows for this earnings growth is these Mag 7 companies came into the AI build-out incredibly cash-rich, which was a much different situation than you saw in the 90s. The cash was sitting on the balance sheet. The cash was available for them to invest the CapEx in AI itself. So I think that's obviously a positive condition that when you try and compare it to the late 90s, I think it's a different circumstance. I do think, in general, a lot of people like to make this binary assertion. Okay, it's the 90s, it's not the 90s. Well, if there's anything in your portfolio where you feel as though there could be a similarity to the 90s, then guess what? You're overexposed.
No,
you're intoxicated with the performance.
Fine. For example, for somebody who runs an ETF whose hands are tied, other than for quarterly rebalances, what's the thought process when you're sitting on a Micron in the Joe T and you're essentially forced to sit there and just watch it go parabolic, knowing that you can't do anything about it? But if you owned it personally, you certainly would have more options. I'm wondering what the pro versus average Joe mentality would be in a name like that.
So you're going to find my answer interesting. First of all, it's 500 U.S. large cap companies. So you could make an argument that the strength of the balance sheet is a little bit different and the volatility levels are also different. But guess what? When I look at it and I say to myself, okay, what exposure do we have currently? I wish we had more momentum. I wish that we were a little bit less quality. We're 50% momentum. We're 50% quality.
Look at
Quality's not getting rewarded so far year to date. Quality's up, I think, 3%.
Because you have. Hey guys, welcome back to my channel. I hope you're doing well today. So without wasting time, let's start our video. And the next growth wave could be bigger than the market realizes. Over the last few weeks, investors has been focused on one question: has the AI trade gone too far? After a massive gain across the semiconductor, AI infrastructure companies and hyperscalers, many investors are wondering whether expectation has simply gotten ahead of the reality. But beneath all the market noise, a very different story is unfolding. The world still doesn't have enough compute, and that's maybe the single most important fact for understanding where Nvidia could go next. Think about what's happened recently. A brand new AI hyperscalers emerged almost overnight. Massive cloud contracts are being signed. Technology companies are raising billions of dollars to expand infrastructure. And every major AI company continue asking for more compute capacity, not less. More. That's the key detail many investors continue overlooking. The conversation is no longer about whether AI demand exists. The conversation is about how quickly the industry can build enough infrastructure to satisfy it. And so far, the answer appears to be honest, not fast enough. Even after years of investment, compute remains scarce, memory remain constant, advanced packaging remain constant, power remain constant, data center construction remain the constant. Nearly every major bottleneck still exists. That's why executives throughout the technology sectors continue talking about shortage rather than the oversupply. Historically, technology bubble were often characterized by the infrastructure being built before demand arrived. Today, AI market look almost completely different. Demand is arriving before the infrastructure exists. New capacity get utilized almost immediately. New clusters fill up rapidly, and customers continue searching for additional compute wherever they can find it. That's an incredibly important distinction because it suggests the AI build out is still being pulled by the demand rather than pushed by speculation. Meanwhile, Nvidia remain at the center of nearly every major trend driving this expansion. Whether it's hyperscalers or is an AI project, enterprises deployment in robotics and automation systems, or next generation cloud infrastructure, Nvidia technology continue appearing almost everywhere. And increasingly, the story is shifted beyond the training. Inferences becoming the next major growth engine. Training build intelligence, inferences monetize the intelligence, and every AI response generated for user require inferences. Every AI assistance require inferences. Every AI agents, every AI powered application require inferences. As AI moves into the consumer product, enterprises software, healthcare, finance, manufacturing, and the robotics. Inferences demand could become dramatically larger than many investors currently expect. That brings us to the one of the most interesting development happening right now: consumer AI. For years, artificial intelligence largely lived inside the data centers. Now it's beginning to reach everyday users. AI-powered smartphones, AI-enabled PCs, personal AI assistants, on-device reasoning, enterprises, copilots, digital agents, and addressable market is becoming much larger. And every new users create additional demand somewhere in the computer stack. That's why many investors believe we are only beginning to see the second phase of AI revolution. First phase was infrastructure deployment, and second phase was mass adoption. And mass adoption could ultimately require far more compute than the industry currently possesses. Of course, none of this means we are don't be volatility. Market never move in straight line. There will a correction, there will be a profit taking, there will be a concern about the valuation, and there will be always be a narrative competing for investor in attention. But when you zoom out, the bigger picture remains remarkably consistent. The world need more compute, AI companies need more compute, consumer cloud providers are beginning to demand for more compute, and Nvidia continues supplying the technology powering all of